Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to talk about the top reasons why you shouldn't buy a SPIA when looking for guaranteed income from an annuity. For those that don't know what a SPIA is, a SPIA is a single premium immediate annuity. It's the most basic, the OG of annuities. You give the insurance company a lump sum of money, and in return, they give you a series of payments over a fixed period of time or for the rest of your life. There's a lot of trade-offs and some better alternatives out there that could provide potentially a higher income with more bells and whistles and more flexibility to you. So we're going to go over the top reasons. Here we go. The first one being the loss of control. Your money is gone. So once you buy a SPIA, your lump sum converted into income payments, and you no longer own or control that money. What you get in return is what's called an irrevocable stream of income. And I want you to focus on this word irrevocable, which means you lose all control over your money. Your money now becomes the insurance company's money, and you're just going to accept a paycheck as if you were still working, and that's what you're going to get. Why this is bad is because it's an irreversible decision. Most SPIA contracts don't offer the opportunity to change your mind. So if something dramatic happens, and health-wise or financially or anything like that, you want to get access to your lump sum of money that you gave to the insurance company. Tough. You know, that's just basically the answer is tough. There's nothing you can do about it. Another reason, poor death benefit options. Unless you get the life with cash refund option, you're going to get your death benefit. You're going to provide either no death benefit, or death benefit is going to be reduced, or the death benefit is going to be a series of irrevocable payments for a fixed period of time to your beneficiaries. And that's good for some people, but some folks don't want to take a death benefits. But when I say some folks, some beneficiaries, they don't want to take their money all at once. That option's off the table. And with SPIAs particularly, the more flexibility or the more easier it is to access the money, the lower the payment that you get. Okay, so you get a cash refund death benefit, you're going to get a lower payment than if you got an installment refund or life only or a life with period certain. So keep that in mind. The inflation, the COLA riders they have on SPIA suck. They're basically, hey, we'll give you a lower payment and then we'll ratchet it up on an annual basis. And we'll go over the alternative for that as well. You don't earn interest. Really, they give you a little bit of interest, about 1.5% baked into the payments, but it's nothing worth writing home about. The only time that we recommend doing some sort of SPIA outside of a niche scenario is if you're under 59.5 and you've got a large sum of cash that you are able to use in exchange for a lifetime income. So for example, let's just say that you became wealthy early on, or let's just say you're an investor, like you're a day trader, or you're in Bitcoin, or you invest in real estate, and you want to have some sort of safety net for your investment. Well, you can open up a non-qualified life-only SPIA, and it'll give you a contractually guaranteed income for the rest of your life. The caveat there is we always recommend getting a term life insurance policy, and term life insurance being because it's the cheapest type of life insurance to you, and do it for the amount of the annuity purchase. So if you buy a $1 million SPIA at age 45, get $1 million 20-year term life insurance policy so that you make sure your investment is protected. And then you can skirt the IRS early withdrawal penalty prior to age 59.5. Some other things that are wrong with SPIAs, when you're shopping for a SPIA, the rates change. Well, the rates are directly influenced by the interest rate environment, and they change on a weekly basis. So if you shop for a quote today, they're probably going to be different next week. Okay. it's just overall, for the most part, not worth giving up control of your assets to an insurance company, right? And most people who buy SPIAs do it because they don't know better. They don't know that there's better alternatives out there, which leads into what is a better alternative? Well, you can get, in the early 2000s, the insurance companies created in the evolution of the annuity, called what's called a guaranteed lifetime withdrawal benefit. And what it is, it's an add-on or an upsell or a bell and whistle that you add on to either a fixed annuity, a fixed index annuity, or a variable annuity. And it typically comes for a fee. Sometimes it's at no additional cost, but the income guarantees are lower than if you paid for a rider. And the guaranteed lifetime withdrawal benefit is a rider, also known as a lifetime income rider. And basically, you attach it to your fixed annuity, fixed index annuity, or your variable annuity, and it will give you the same concept of a contractually guaranteed income for the rest of your life. Why it's better than a SPIA is, number one, you're able to earn interest out the gate. Whatever death benefit there is, it'll either be in a lump sum, spousal continuance, or over a series of payments. And the owner has choice over that death benefit. The beneficiaries have a few choices, but you can dictate how the death benefit's paid out. Right now, as of 2026, the guaranteed lifetime withdrawal benefits have higher payouts than SPIAs. The inflation rider is better. It starts out at a higher payout and it increases. It offers higher increased payment opportunities than a SPIA does. Then there's other bells and whistles like long-term care, nursing home, assisted living, disability type of waivers. And then the main thing is you, the annuity owner, retain ownership over the annuity. And if you decide that you need to change your mind or an emergency happens, you can cancel that contract. Yes, you'll probably place some sort of surrender charge early on, but it's better to have that choice than not have that choice. So far superior, and there's other things like bonuses and being able to participate in the stock market without being in the market. Then there's if you want to actually be in the market. So there's all different types of. If I'm doing a T-chart, which is a comparison weighing the pros and the cons of a SPIA compared to a GLWB, the GLWB wins in almost every scenario. Now, where SPIAs outshine guaranteed lifetime withdrawal benefits is the taxation part. If you're funding a non-qualified SPIA, and let's just say it's coming from a deferred non-qualified product like a non-qualified annuity, or it's coming from a cash value of a life insurance policy, and you're 1035 exchanging it, well, then the taxation is better because it's called an exclusion ratio. So your paycheck that you're receiving is proportionately taxable to non-taxable, where if you took income from a GLWB, it's LIFO, which means all your gains are going to be taxed first until you eat into your original after-tax money. So other than that, we do not see a whole lot of opportunities or scenarios where a SPIA is a better option. And if you're looking for guaranteed income, look for a fixed annuity, fixed index annuity, or a variable annuity with a guaranteed lifetime withdrawal benefit, otherwise known as a lifetime income rider. You'll thank me in the end. If you want to, you can come to the Annuity Expert. Just go to your favorite search engine, type in the Annuity Expert, we'll show up. Go here to our calculator, retirement-based calculator, annuity calculator. And here you get real-time, updated in real-time payouts, and you can see how much lifetime income that you could get, whether that's immediate or in the future. And then like, subscribe. If you have a question, comment below. I'll respond with an answer without you even having to email us or contact us. But if you do want to contact us, you can go to 770-755-1565. Shoot us an email, chat, or give us a call. Hope this answered your question, and we'll catch you on the next video.